Alrighty, welcome to another monthly recap. This is from month ending today, August 30th, 2024. Hope you guys had a wonderful month and looking forward to a nice long weekend. Heck yeah, all for it. Alrighty, so August was a very busy month. I always say that. I know, but every month is a busy month. We just lose sight of it. So, August, jobs market cooled down. We're going to be talking about Bureau of Labor Statistics a fair amount. I'm going to be trashing the government department in charge of labor statistics here for a bit. So that'll be fun. Markets go on a roller coaster ride. It was a wild ride for the markets. The Fed also wrapped up their Jackson Hole Symposium. There's a rate cut on the horizon in September. So looking forward to that. I've been for months now. And then we're going to be talking briefly about what happens when the Fed cut rates. What does that actually even mean? There's a lot of misconception around what the Fed funds rate is, what it does, how does it impact mortgages, all of that. As a whole, mortgages decreased from about 6.625 down to about 6.375%. That'd be a first-time home buyer making less than 120% of the area median income, no points, good credit, that kind of scenario. So let's get into it. Let's start with the Bureau of Labor Statistics. Okay, so Bureau of Labor Statistics, literally an department of the government who's in charge of simply trying to figure out what is the employment situation in the U.S., right? The Fed relies on that information. They have a dual mandate. Yes, they want to keep inflation in control. They also need to make sure that they are maximizing employment. So they rely on Bureau of Labor Statistics, right? So on August 2nd, very beginning of the month, Bureau of Labor Statistics reported that there was 114,000 job gains in July, okay? That was pretty soft. That was already pretty soft. There was expectations for 175,000. And worth pointing out that 63% of those job gains were in government and healthcare. Why is that important? Well, government jobs and healthcare jobs are not dependent on the economy, right? They're completely independent. Like, we're still going to need doctors. We're still going to need nurses. That's not going to change. People are still going to get sick. That's not going to change. So, yes, the job gains were weak, and not just weak, but also 63% of them were in, components, sectors of the economy that are completely independent of how the economy is performing. Then we got the unemployment rate. The unemployment rate jumped from 4.1% to 4.3%. That's crazy because literally just a few days before that, the Fed came out and said, yeah, no, we think we're not going to see employment above, 4.1% for the rest of the year. It jumped to 4.3% literally just a couple days later. If that wasn't bad enough of a month for Bureau of Labor Statistics, they then came out and they said, hey, look, for the year ending in March of 2024, so that 12 months prior, we overstated job gains by 818,000 jobs. 818,000 jobs, that's 28.1% of all the jobs they said were gained, poof, did not exist. Simply did not exist. They were overstating jobs by 28.1%. Like, that's crazy, absolutely crazy. It's the largest downward revision in 15 years. And has me asking the question down here, what would you say you do here? Your whole job is to figure out how many job gains, what's the unemployment rate, and you completely missed the boat. If I was off on my numbers by 28.1%, I would not have a job anymore. Yes, the Bureau of Labor Statistics has a very challenging job. They use a lot of modeling where they try to figure out birth-death ratios, how many businesses were created versus lost. They try to figure out like a household survey where they call a few households and try to figure out what the unemployment rate. It's really hard to do. I understand that, but missing the number by 28.1% is crazy. And we've been seeing this, right? We've been seeing some significant numbers from BLS and then they revise them lower. Significant numbers from the BLS and then they revise them lower. So it's a little bit of a mess over at the BLS. I'm going to be talking about the BLS again in a little bit, but more to come on that, okay? BLS had a terrible month and it caused a lot of market volatility. Right. So the week of 7/29 to 8/2, the Fed wrapped up their meeting. They confirmed, yeah, there's concerns about the labor market. Maybe they knew what the BLS was about to report. But they also acknowledged, look, we've been seeing good improvement on inflation. We're feeling pretty good with where things are. Then BLS came out with their bad numbers from the month before. And then mortgage rates ended up finishing off the week pretty well. Mortgage rates don't tend to move with the stock market, right? When the stock market has a great day, the bond market tends to have a bad day. So good news for your 401k tends to be bad news for mortgage rates. But week ending of August 2nd, rates were doing very, very well, lowest level in about a year. Then the weekend of 8/3 and 8/4 happened. And there was a lot of after hours trading. And if you recall the headlines, Japan was kind of front and center. They were all panicking. They saw this unemployment rate increase from 4.1 to 4.3%. They all started to kind of freak out. Oh my gosh, maybe the US is headed for a recession. Maybe that soft landing that the Fed was trying to do does not work out. Oh no, oh no, oh no, what happened? What happened on that Monday, August 5th? The Dow dropped 1,033 points, fell 2.6%. S&P dropped almost 3%. It was bad day for the markets, bad day for your 401ks, if you recall. Then what quickly happened after that? Well, between 8.6 and 8.19, stocks started to improve. They clawed their way back. They actually set new highs after that. And then on the mortgage front, rates started to worsen because the stock market's performing very well. People are taking their money out of the bond market, putting it into the stock market, and that caused mortgage rates to increase. In my world, what happened was the news started to report on these record low rates, or the lowest rates in over a year. They started reporting on rates of August 2nd. They didn't do that until a week later, which was when rates had already jumped like 0.375%. So the news is terrible at predicting what mortgage rates do. They don't talk about them in real time. If you want to talk about them in real time, call me because the news does a terrible job. They are always a week behind. And they were certainly a week behind on this. So I'm still starting to get some calls like, hey, I heard rates dropped. I'm like, yeah, that was like a month ago. So that's what we saw. So crazy volatility in the markets, causing some heart palpitations over in Aaron Staufer land. But anyways, let's talk about our hawks and our doves and see how they're doing, right? Hawks and our doves have been playing tug of war, trying to find out when the Fed is going to cut rates. Well, here's kind of an update on this tug of war match. So again, hawks want to keep rates elevated. Doves want to drop rates. Okay. So as unemployment ticks up, both hawks and doves get more dovish. Conversely, if inflation heats up, both hawks and doves are going to get more hawkish. Okay. They have this dual mandate, trying to keep unemployment down and also keep inflation down. Right. So in April, if you recall, inflation was very stubborn. The employment numbers were strong. Turns out a lot of those were false. After that, things started to kind of go in the direction of the doves. Things started to improve. We saw cooling inflation, weakening in employment figures. All that was good for doves. And that is now leading us to the next Fed meeting, which is September 18th. It is a big meeting. I've been circling this date. I've been telling you to circle this date for months now. It is a big one. Okay, September 18th. Not only is it a Fed meeting, but it's a Fed meeting that's associated with the summary of economic projections. That's really important. And I alluded to this a few months back. Like typically when the Fed starts to cut rates, they tend to do so in conjunction with one of these summary of economic projection meetings because it gives them a platform to explain their reasoning, to not just make the decision, but show their work. Where do we think rates are going to go from here? What do we think is going to happen to unemployment? They have to do all that at those meetings with the summary of economic projections. Okay. So this month you'll see, hey, look, there was no meeting in August. That's correct. July 31st, September 18th, right? Big gap in here. So what happens in this gap? What happens in this gap is the Jackson Hole Symposium. Beautiful landscape, Jackson Hole. Anyways, Jackson Hole Symposium. So what is it? It's not a formal meeting, okay? It's not a formal Fed meeting. There is no Fed rate decision met, but it is a gathering of Fed members, academics, market experts, media, and what they do is they try to take a longer-term approach, longer-term viewpoint. Like, hey, what is our long-term strategy? What is our long-term approach? What are the market conditions? They discuss all of that, okay? And at the very end of it, Jerome Powell, Fed Chair Jerome Powell, comes out and he gives a speech. It's usually focused on the horizon. It's not usually focused on the present. This meeting, however, was all about the present. So the meeting took on a little bit of a different tone. And the reason it took on a little bit of a different tone is because they have this big meeting looming on September 18th, okay? So everybody was like, who cares about the long term? What's going to happen next month? So Jerome Powell said this, I'm going to read it verbatim. The time has come for policy to adjust. The direction of travel is clear and the timing and pace of rate cuts will depend on incoming data. It's a key part there, incoming data, the evolving outlook and the balance of risk. Okay. So this is all Fed speak, right? They don't come out and say, yes, we're going to cut rates, but the time has come for a policy to adjust. They're saying there's going to be a rate cut. There's officially going to be a rate cut on September 18th. Is it going to be 0.25% or is it going to be 0.5%? Pace of cuts will depend on incoming data. What data? Well, there's a big piece of data that's due out next Friday. Big piece of data due out next Friday. And that is the jobs report for August. Okay. So next Friday, we're going to be getting the Bureau of Labor Statistics report for August. BLS, yeah, they missed significantly earlier this month. They admitted to being off by 28% over the course of a year. They also showed a surprise for unemployment. Rate jumped from 4.1 to 4.3%. If there's another surprise, it is entirely possible that the Fed would consider seriously a 0.5% cut. More on that in the next slide. Okay. If, however, unemployment stays the same, if maybe it even comes down from 4.3 to 4.2%, something like that, all of a sudden, maybe the Fed feels empowered to only do a 0.25% cut. Now, current market odds. So they're saying that there's a 33% chance of a 0.5% cut on September 18th. They are saying there's a 73% chance that they're going to cut rates 1 full percent by the end of the year. And they're expecting 1.25% cuts in 2025. So that's what the market is currently predicting. Now, let's talk briefly about quarter or half, right? Quarter or half. A lot of people are saying, look, there's no chance of the Fed cutting rates 0.5%. 0% chance, simply not going to happen. But history tells us a little bit of a different story. In 5 of the last 6 cycles of rate cutting, the Fed cut rates by 0.5%. There was the dot-com bust in January of 2001. They cut rates 0.5%. After a year and almost 2 years later, they were saying, hey, look, this is a weak recovery. We need to cut rates again. They did another 0.5%. Housing bubble popped, right? 2007, 0.5% cut. Great Recession started, 0.5% cut. There was a mid-cycle adjustment in 2019. That's where they did only a 0.25% cut. But then COVID-19, 0.5% cut. That was that emergency meeting where they just slashed the Fed funds rate, right? So to say that there's no chance of the Fed cutting rates 0.5% is wrong. History tells us a different story. It's really, really going to depend on what are those numbers on September 6th. If the BLS misses the boat, if unemployment ticks up again, the Fed's probably going to start get a little anxious, and they're probably going to feel a little bit more empowered to do a little bit more of an aggressive cut. We shall see. It's going to be very, very interesting. So let's talk about what happens when the Fed actually does cut rates. Okay, there's a lot of misconception, a lot of misinformation out there. So what is the Fed funds rate? The Fed funds rate is the rate that lenders exchange money with one another at. Okay, one institution may borrow money from another institution. What rate are they borrowing that money at? Okay, that is what the Fed funds rate is. So any portfolio financing, okay, anytime it's the bank or credit union's own personal money that we're lending out, okay, that will be directly and fairly immediately impacted. So your credit cards, your home equity lines of credit, those are all portfolio loans, right? There's no secondary institution behind them. It's all the institution's own personal money. Those rates will drop by that same percentage. They should, okay? New personal loans, new student loans, new auto loans, all will have a lower rate. Those are all portfolio loans. Those tend to follow the same trajectory, okay? Negative side of that is your savings deposits, your savings account, and your new certificates of deposits also will have a lower rate. Those are also going to track because those are also portfolio, right? It's the bank that's holding on to your money, your credit union that's holding on to your money. So those will be impacted as well. New mortgages will not immediately drop by the same amount, okay? They are not portfolio loans. They are backed by Fannie Mae and Freddie Mac. The vast majority are backed by Fannie Mae and Freddie Mac, or FHA and VA, okay? So big misconception that mortgage rates are going to drop by the exact same percentage at the exact same time. Over time, they follow the same direction, but it's not going to be immediate. It's not going to happen instantaneously, okay? Mortgage rates have already kind of improved in advance of this meeting, okay? There's been a lot of talk. People are kind of rebalancing their expectations. The reason why rates had a good month was on the expectation that the Fed is going to cut rates in September. So some of the improvement to mortgage rates has actually already been seen and felt. They will not react the exact same way at the exact same time. So pump brakes a little bit on that. It'll take some time for that to actually bleed its way through the entire market. All right, let's look ahead. So what's going to happen in September? So Bureau of Labor Statistics report due out next Friday. It's going to be a big week. We're also getting the JOLTS report, Job Openings and Labor Turnover Survey. We're also getting ADP employment report, BLS report. All of those are due out next week. It's also a holiday shortened week with the markets being closed on Monday for Labor Day. And then updated inflation data. We're going to be getting CPI, Consumer Price Index, PPI, Producer Price Index. Those are coming out right before the Fed's meeting on September 18th. That's the big one. That's the biggie for the month. It's going to be very, very interesting. Will they cut 0.25%? Will they cut 0.5%? I'm really keying in on next Friday. If that number comes in and unemployment jumps I'd be surprised, honestly, at that point if they don't cut rates 0.5%. I think it'll give them enough ammunition to do so. If it's the same, if it's lower, I would probably bet on 0.25%. So we shall see. Going to be very, very interesting next week. All right, that's all I got for you. Hope you all have a wonderful weekend. Hope you all had a wonderful month. If you need anything at all, let me know. That's my cell phone. Text me, call me anytime. I appreciate you all. Have a wonderful weekend. Have a wonderful day, and catch you next time. Thanks.